Hi, my name's Mike Ehrlich. I'm a professor at New Jersey Institute of Technology and Finance, and I'm here to talk today a little bit about taxes. Now, taxes are very complicated, and there's a reason why tax attorneys and tax accountants get paid a lot of money, because this is a really hard job. But I'm going to try to talk about a very small part of it, a simple part of it, where I can hopefully lend some clarity to what we can expect to happen, and maybe unexpected things happen, with the new tax increase that Obama is proposing on the wealthy, that is defined as people making more than $250,000 a year. In the U.S., we have two different ways of calculating taxes, started actually in 1970. There's the standard calculation that most people are familiar with, but then there's another calculation called the alternative minimum tax. This was a calculation first invented, actually, I think about 1970, when Congress noticed that there were 155 Americans who had very high incomes, but were able to make so many deductions from their incomes that by the time it came time to pay taxes, they paid zero in taxes. And Congress was horrified that there could be 155 very wealthy people that paid zero in taxes, so they established a second calculation to say, you couldn't, if you didn't count all those deductions, what might your taxes be? And then there's these two calculations. You pay, in the best tradition of American taxes, they do these two calculations, and you will pay the higher of either one of those calculations. Now, it turns out that over half the Americans who are likely to be affected, that is making more than $250,000, live in either California or in the northeastern part of the United States. So, and those two areas are areas that are very prone to the alternative minimum tax, because they both have, those are areas with high state property taxes as well as very high local taxes. So those are both major areas of deductions, and also high property values lead to high mortgage deductions. So those areas are very prime areas for the alternative minimum tax. So there's an example which we can take that Deloitte did for the New York Times, where if you're a couple living in New York and you have two children below the age of 17 and you make $300,000 a year, now a fairly healthy amount obviously, but you are then going to be paying many deductions, and so you'll have maybe a $36,000 deduction for mortgage interest, maybe a $6,000 deduction for charitable contributions, maybe another $15,000 deduction for state income taxes, and maybe an additional $15,000 or so for local property taxes. By the time you add those all up and you do the two calculations, it turns out that person last year paid about $8,000 more in the calculation for the alternative minimum tax than they would have for the regular standard calculation of taxes. So the question, what's then going to happen to, say, this typical person or this typical wealthy person when Obama raises the marginal tax rates from 33 and 35% to 36 and 39.8%? Well, it turns out it may not be what people think. Those people are already paying the alternative minimum tax. So when they do their two calculations this year as opposed to last year, they may discover that their standard tax burden is going to go up. It might go up by $5,000. But if it goes up by $5,000, it turns out that that's still going to be below the alternative minimum tax calculation by approximately $3,000, which means that their tax bill this year in a higher tax period may actually be the same as it was last year under the alternative minimum tax. So without a change to the alternative minimum tax, they may see no tax increase whatsoever, and it's only going to be the very wealthy, people maybe earning more than $400,000 or $500,000 a year, who actually get hit by those higher marginal tax rates.